Welcome to the Explainer. Today, we're diving deep into the Income Tax Act of 1961. Now look, I know the word taxes usually makes people want to run for the hills, but stick with me here. We're going to take this massive, honestly intimidating legal system and break it down into a super structured, crystal clear journey. We're going from the absolute basics all the way to the final boss level, actually computing your total tax liability. We've got the rules, we've got the roadmap, and we're going to crack this code together.
Here's the roadmap for today's Explainer. We'll hit income tax basics, then the 5 heads of income, handling losses and set-offs, deductions, which is how you save your money, and finally, computing your total tax.
All right, part 1, Income Tax Basics Explained, laying the groundwork.
So what exactly counts as income? You're probably thinking, well, my salary, obviously, right? But hold on, it's actually way bigger than that. Under Section 224 of the Act, income is this incredibly wide, totally elastic concept. It's an inclusive definition. That means it doesn't just cover profits, gains, and dividends. It literally catches anything of value coming your way, things you probably wouldn't even expect, like rent-free accommodation from your employer. Yep, that's income. Cash assistance, income. The government has cast a seriously wide net here.
Okay, let's clear up a classic mix-up that trips up almost everyone. First, an assessee. This is just the person who's actually liable to pay the tax. Simple enough, but the timeline is where it gets tricky. The previous year is the financial year you actually earn the money, running from April 1st to March 31st. Then, the assessment year is the year right after that. That's the year you sit down, do the math, and actually pay the tax on what you just earned. So if you're earning a salary right now, you're currently in the previous year. Next year, when the taxman comes knocking, that's your assessment year.
Now, we're going to talk about the huge difference between being smart with your money and, well, being a criminal. Tax planning is the legal, totally permissible way to arrange your finances to maximize exemptions and deductions. It's basically the government saying, hey, if you play by our rules, you get to keep more of your own money. Tax evasion, on the other hand, is the illegal suppression of facts, hiding income, submitting fake documents, the bad stuff. The whole goal of this explainer is to make you an absolute master of tax planning so you can legally and safely minimize your tax burden.
Moving on to Part 2, the 5 heads of income, categorizing your cash. Under Section 14, every single rupee you earn has to go into one and strictly only one of 5 specific buckets. First up, income from salaries. This includes your basic pay, allowances, and perquisites. Then, income from house property, which taxes the rent, whether actual or notional, from real estate you own. Third, profits and gains of business or profession. Fourth is capital gains. That's the profit you make selling assets like property or shares. And then we have the 5th head.
Income from other sources. This one's the residuary head. It's the ultimate catch-all bucket. Basically, if you earn a rupee and it doesn't neatly fit into salary, property, business, or capital gains, it drops right in here under Section 56. So we're talking bank interest and dividends, sure, but it also includes some pretty, let's say, entertaining stuff.
Oh yeah, the government absolutely wants a cut of your lucky weekends. Casual income falls straight into this 5th head. Win the lottery, finally crack that Sunday crossword puzzle for cash, win big at the horse races, or have a crazy lucky streak at cards, the taxman is literally sitting right there at the table with you. It's unanticipated, non-recurring income, but make no mistake, it is highly taxable.
And here is the kicker, that massive 30% hit. Under Section 115BB, these casual income windfalls get taxed at a flat, totally unforgiving rate of 30%. And actually, it gets worse. There's absolutely no basic exemption limit, and you can't even claim deductions for the money you spent buying the lottery tickets in the first place. The government just takes 30% straight off the top, starting from the very first rupee.
All right, Part 3, handling losses and set-offs. Making losses work for you.
So let's look at how the tax code actually builds a bit of a safety net into the system. If you take a financial hit, you don't just lose the money, you can actually use that loss to reduce your taxable income somewhere else. Section 70 allows for what's called intra-head set-offs. Think of it like this. If you run 2 businesses and one turns a profit but the other tanks, you can net them against each other. Then Section 71 goes even further with inter-head set-offs. This lets you use a loss from one category, like house property, to offset taxable income under a completely different head. It's this brilliant tool for cushioning the blow before calculating your final income.
Which brings us to Part 4, Deductions, Saving Your Money. Chapter 6A to the rescue.
Now this right here is exactly where you get to legally shield your hard-earned money. I'm talking about the chapter VIA deductions.
The government actively wants to encourage certain behaviors, saving for retirement, taking care of your health, donating to charity. And in return for doing those good things, they let you subtract those amounts straight out of your taxable income. It's a win-win.
The absolute reigning champion of these deductions is Section 80C, which caps out at 1.5 lakh rupees. This is the bread and butter of everyday tax planning. You can claim this for investing in a public provident fund, life insurance, or, and this is my personal favorite, paying your kids' tuition fees. Seriously, the exact moment you realize paying your toddler's insanely high kindergarten fee literally turns them into your best tax shield, yeah, that's a really good day.
And here's a super practical one. Section 80E. If you're staring down a terrifying mountain of student debt right now, the government basically steps in and says, hey, sorry for the stress, here's a massive tax break. You can deduct the entire amount of interest paid on an education loan for yourself, your spouse, or your kids for up to 8 assessment years. And get this, there is absolutely no upper monetary limit here. None. For early career finances, that is an absolute lifesaver.
The tax code also builds in these flat deductions for disability under sections 80DD and 80U. Now, what makes these unique is that the government offers fixed relief, either 75,000 or 125,000 rupees, depending on severity, regardless of what your actual medical bills are. That means no frantic hoarding of every single pharmacy receipt. Section 80DD applies if you're taking care of a dependent, while 80U is for the taxpayer themselves. It's just a solid fixed relief built directly into the system.
Finally, Part 5, Computing Your Total Tax, the final boss.
All right, this is the culmination of our journey, the exact step-by-step waterfall. We definitely don't just guess at the tax. It's this highly systematic process where your initial gross income is filtered, categorized, adjusted, and reduced until we hit that final taxable number.
So let's walk through the logic here. Step 1, you determine your residential status, because that actually decides what global income is taxable in India. Step 2, you compute your income under those 5 distinct heads we just talked about. Step 3, you apply the rules to set off any losses. Step 4, you subtract all those wonderful Chapter VIA deductions, like your 80C investments or your 80E loan interest. And finally, Step 5, you arrive at your total income.
Now, the absolute crucial point here is understanding the difference between these two terms. Your gross total income, or GTI, is just the sum of the 5 heads of income after you've set off your losses. It's the big, scary number. But your total income, that's the GTI minus all your Chapter VIA deductions. And total income is the actual final figure that the government applies the tax slab rates to. So by maximizing those deductions, you actively shrink your total income, which directly shrinks your final tax bill.
Which brings us to the end of this explainer, and to a really important question for you. Now that you actually know the rulebook, from the 5 heads of income to the strategic use of set-offs and those sweet, sweet deductions, how are you going to organize your own taxpayer journey this year? With just a little bit of structure and some smart planning, you are fully empowered to legally keep so much more of your hard-earned money. Thanks for coming along on this deep dive with me, and happy tax planning!